Good morning. My name is Dina Thacker. I'm the head of electronic equity derivative sales at UBS. We are excited for you to join this call this morning. UBS built a comprehensive suite of US options algos to trade index, ETF, and single stock options to maximize liquidity, minimize market impact, and optimize performance. Our algos support trading single legs and spreads with or without a stock leg component. We have a commitment to innovation with an emphasis on stable and resilient platforms and technology. I am pleased to introduce our speakers for this morning's talk on the equity market outlooks. Mandy Zhu is the head of derivatives market intelligence at Cboe Global Markets, and Kieran Diamond is a global markets derivative strategist at UBS. A little housekeeping. We will be having Q&A at the end of the presentation. If you joined by Zoom, select raise hand at the bottom of your screen to be added to the Q&A queue. And if you joined by phone, please hit *9 to join the Q&A queue. This will all be repeated at the end of the call as well. I'm going to turn it over to Mandy to start the presentation. Thank you.
Great. Thanks, Dina. And good morning, everyone. Thank you for having me on today's call. I thought I would spend, a couple minutes addressing probably two of the most commonly asked questions that we get this year. One is on why the VIX is so low, and the second is on zero-day options, right? Zero DTEs. I would say despite the tremendous growth that we have seen in terms of zero DTE trading, there's still a lot of misconceptions and misunderstanding around the product. Who's trading it, what they're using it for, and ultimately what's the potential market impact. But let me start on the VIX and why the VIX is so low this year. Just sharing my slides. I think it's important when we talk about equity volatility to really take a step back and think about it in the context of broader cross-asset volatility, right? And so what I'm showing you here is a chart of cross-asset vol. Now, as we know, volatility of different asset classes trade differently, often defined differently as well. So in order to compare apples to apples, what I've done here is standardize everything to Z-score. So a Z-score tells you for each asset class volatility, how many standard deviations above or below it's currently trading compared to its long-term, in this case, 10-year history. So a Z-score of 2 in this case would be 2 standard deviations above average. A Z-score of -2 would be 2 standard deviations below average. So as you can see on this chart, we have, rates vol in blue, equity vol in red. We also have commodity volatility, FX vol, as well as credit volatility. When I look at this chart, two things kind of stand out to me. The first, obviously, if you look at rates vol, the persistent richness of rate volatility, perhaps not surprising given what's going on. But the second thing, and the thing I really want to call out, is just the decline that we've seen in volatility across asset classes. And this is why I think it's important to start here, because oftentimes when we talk about why volatility is low, why the VIX is low, people tend to gravitate toward more like equity-specific factors, right? Is VIX low because of zero-day to expiry options? Is it low because of the proliferation of yield harvesting or vol selling strategies? Is it low because of systematic strategy rebalancing? I mean, yes, like all of these may play a role, but I would say the dominant factor why VIX is low is also the same reason why volatility is low across every asset class right now. And that's really macro fundamental, right? That shift in narrative and focus away from recession risk towards soft landing, that building of consensus around soft landing is why volatility has fallen across every asset class. And as you can see, the decline in the VIX is really in sync and in line with what we're seeing across FX, across credit, across commodities. It doesn't stand out as being particularly cheap on a cross-asset basis. And that is also, I would say, when we talk about, kind of goes hand in hand with why stocks have been so resilient this year, right? In the face of higher rates. That's another common kind of follow-up question that I get. And what you'll see on this chart in the blue is the 10-year yield, and everyone's kind of familiar with kind of the price action there. Obviously took a big leg higher last year and has continued to make new highs this year. And really the point of this chart is to say, it's important to dissect why rates are going higher to really understand the impact on equities, right? And so what I'm showing you here in the white line is the Fed rate expectations further down the line. So specifically, this is looking at the SOFR Z3, Z4 spread, so the DEC 23, DEC 24. spread. You can think of this line as kind of how many rate cuts or rate hikes people are expecting for 2024. And really the big change is, as you can see last year, as rates were going higher, as the Fed was very aggressively raising rates in the near term, investors were also pricing in very aggressive rate cuts down the line because of this belief or this idea that the Fed was going to over tighten and drive the economy into a recession, right? And that's why stocks also fell alongside higher rates. But kind of fast forward to this year, and particularly more recently, what you'll see in the white line is that those rate cut expectations have been cut by about half. So this really kind of speaks to this idea of soft landing now being achievable, right? Everyone's coming around kind of to the Fed's guidance of rates higher for longer. And really another way of saying, this year, the move in rates is really led by the long end, the 10-year, 30-year. It's come on the back of better economic growth numbers. And that's still, that's ultimately a constructive backdrop for risk assets. And that's why I believe, stocks have been so resilient for the most part this year in the face of higher rates. Now, in terms of higher rates, the impact of higher rates, it's not really being felt at the index level when you look at the VIX, but it is being felt at the single stock and at the sector level. So another, I would say, distinguishing feature of the market action over the past year has been, even as index volatility has declined, we have seen sustained high single stock volatility and sustained high dispersion between stocks, between sectors. And that's, what this chart is showing over here. So in gray, you have, the VIX index, and in blue, you have our newly launched S&P 500 dispersion index, ticker DSPX. It's a measure of 1 month implied dispersion of the S&P 500. And I'm taking a 3-month moving average here to really smooth out the earnings seasonality to kind of take a bigger picture view. And what you'll see is that, over the past 18 months, average levels of dispersion kind of on par with what we saw in 2020 when the VIX was at 90, right? And that's just another way of saying that we've seen incredible amounts of volatility and rotation at the sector and the stock level, changing sector leadership between, growth value, cyclical versus defensive, old economy versus tech stocks, that whipsawing, kind of between those factors, those sectors, we're seeing a lot of volatility underneath the index surface, but because of high dispersion and low correlation, index volatility continues to remain muted. And that low correlation really is pretty remarkable. If you look at the S&P 1 month implied correlation levels over the past, 3-4 months, it's traded in a very tight range of between 20 to 30. So despite the market correction lately, we've not really seen an uptick in correlation at all. And that again speaks to the focus on fundamental risk, on higher rates and the impact that's having at the stock level. And I would argue kind of that low correlation not only is, one of the primary reasons why vol is low, but also explains the underperformance of skew and convexity that we've seen. That correlation that has not picked up on the way down. Obviously impacting those secondary risk metrics as well. So we talk about where we are seeing shifts and changes and perhaps more fear being priced into the market. It's not in the S&P vol surface, but it is in the VIX vol surface. So one of the big changes that we've seen this year is a significant uptick in VIX option volume, up about 40% and really primarily led by an increase in upside call demand. Got a lot of questions as to why that is, given the generally positive risk backdrop for this year. I would say a couple of factors, right? So first, people typically buy VIX options as tail hedges, right? To protect against potential black swan events. By definition, those typically happen when volatility is low, or in other words, least expected. And then, think about why people buy VIX upside calls is to play that convex move when volatility doubles, triples, or even quadruples. And obviously that's a lot easier to do when it's, averaging in the mid-teens like it is this year versus say the mid-20s like it was last year. But I would say that's not all, right? Because there have definitely been years in the past, for example, 2019 when the VIX was similarly low, but we didn't really see that uptick in VIX option volume. So I think the second factor really comes down to positioning and leverage, right? So again, volatility goes up when market sell-offs become disorderly, when everyone kind of heads to the door at once. And to get that, you really need that buildup of positioning and leverage. And that's exactly kind of what we've seen this year in sharp contrast versus last year, right? Last year was all about deleveraging and shifting to cash. This year, across both discretionary and systematic strategies, we've seen increasing equity allocations. We've seen build up to in leverage across all of these different strategies. So kind of the preconditions are there for potential disorderly sell-off if we do get that potential black swan event. And again, what that has meant, all this VIX upside call buying is, VIX convexity compared to S&P is definitely screening very rich, as you can see in the second chart here. Okay, so now let me shift gears a little bit and talk about S&P zero-day options. I won't spend too much time on it. I know Kieran has a great section kind of with a deep dive on some of the volumes that we've seen in zero-day options, but very broadly, and I think this is, everyone's familiar with the story here. Zero-day options now comprise anywhere between 40 to 50% of S&P volumes. In recent months, it's really close, hovering closely to closer to 50%. Of all S&P volumes. We're talking, over 1 million contracts, well over 1 million contracts trading per day and in zero DTEs. What are people using these for? I think it's worth emphasizing there's actually a diversity of use cases that we've seen kind of from both institutional as well as retail clients. It's not just directional punting of kind of where the market's going to go on an intraday basis. People use these for hedging, whether it's overnight risk, event risk. We see a lot of people using these for yield harvesting strategies, so selling these options to capture the volatility risk premium. As well as more recently, more and more people using zero-day options in place of futures exposure to play intraday, momentum or reversal in the market. In terms of the trading profile, a couple things really worth noting. The first, and this is really specifically, I think, to address the concerns that, the trading in zero DTE potentially could lead to another Volmageddon. It's worth emphasizing that at over 95% of the activity that we see in zero-day options is in some form of cap risk formats, right? So either outright long options, puts or calls, or if they're selling options, doing it in capped call spreads, put spreads, ion condors, those types of structures. So less than 5% is outright short puts or short calls, which again, talking about force unwind, force deleveraging, I think that the probability of that is a lot lower. And the second thing worth noting here is that, risks reset at the end of the day. You don't get that buildup of leverage over time as we saw with the VIX ETNs. The second thing worth noting in terms of the trading profile is just how balanced it is, both between puts versus calls. So put-call ratio typically hovering around 1, as well as balance between buys versus sells. And it's really on this last point I think it's worth emphasizing because a lot of the headlines that you might have read about zero-day options all talk about potential impact on the market, and all of those headlines tend to focus on the gross volume that is traded in zero-day expiry options. But as we all know, what matters for risk in determining kind of net impact to the market, it's not the gross volume, but the net positioning, right? And I break it down simplistically. If you think about 100,000 contracts trading on a particular line, if 50,000 was customer buying, 50,000 was customer selling, then despite the high gross volume, there's actually net zero market maker hedging that needs to be done on the back of that flow because it's perfectly balanced. And as you can see in this chart, in reality, the flow is remarkably balanced, and not exactly 50-50 across every strike, but it's pretty close. And I'm showing here an example from August 15th. If you recall, that was a day where a lot of people kind of came out with theories as to why potentially zero-day options was driving the sell-off in S&P. I don't think really holds water once you really break down the positioning. But that, that's the kind of the point that I want to emphasize is that high gross volume, yes, 500 billion trade on these in zero-day options on a daily basis. But if you look at the net positioning, because of how balanced it is, the net impact of the market is actually fairly de minimis. And if we run that analysis, not just for August 15th, but if we run it for every single day over the past 2 years, and we run it throughout the course of the day, what we can gather is kind of the net market maker positioning throughout time on average, right? So what you'll see is on average, net market maker positioning ranges, we're talking 100 to 600 million throughout the course of the day. And to put that number in context, S&P futures trade about well over 400 billion on a daily basis. So we're really talking about potential average net hedging flow, 0.1%, less than 0.1% of the S&P daily liquidity. And even if you focus on the kind of the min max, the whiskers of the box plot, kind of how extreme, the imbalance could get as it gets closer to the end of the day, we're still talking, a couple of billion, in the context of S&P liquidity. I don't think we're talking about anything super outsized. Another point maybe I'll mention is, we just hosted a panel on zero DTE trading at last week's risk management conference. I had, the co-head of S&P option trading at Optiver on my panel, one of the largest market makers in the space. And one of the things that, he emphasized, well, two things. One is just how balanced the flow that he's seeing in the space. But the second is that when market makers head to the flow in zero DTE, their first choice often is not, hedging with the underlying futures, right? They can spread it against other zero DTE options. They can spread it against, other expiries. They can spread it against, SPY, zero DTEs, E-minis. There are a lot of choices where they can, hedge their risk that do not involve trading in the underlying futures. So again, the net risk is pretty low, and there are other ways that market makers can hedge their position other than trading, hedging convex positions in options with linear instruments and in the futures. And then maybe the last thing I'll end with before I turn it over to Kieran is focus on retail activity in zero DTE and really contrasting what we're seeing in SPX versus what we saw in the single stocks, right, during the 2020, 2021 meme stock era. So I think when people talk about retail trading options, they typically kind of associate all with kind of what happened during the pandemic. This is all speculative. This is all punting. It was back then, right? So if you look at the put call ratio for equity options, you'll see, in 2021, that put call ratio hit basically the lowest since the tech bubble. So we were seeing retail predominantly buying upside calls at the single stock level during that time period. So again, it was a one-way bet on the direction of the market. And by definition, that was not going to be sustainable because eventually when the market turned, that activity disappeared, right? And as I mentioned, the retail activity in SPX, zero-day options, it's very balanced between puts and calls. It's not all just directional punting in terms of where the market's going to go. And that's why I think if you look at the share of zero-day volume, it stayed pretty consistent between 40 to 50, whether the market was going up or down, right? Last year was down 20, this year up double digits. It stayed the same share regardless of the vol environment, whether the VIX was in the 20 to 30 range last year or in the mid-teens. That tells you by definition that the flow has to be balanced, that it doesn't shift materially month to month, year over year, based on what the market is doing and where the volatility level is trading. So with that said, we've already published a lot of information around zero DTEs, including a white paper. If you're interested, please get in touch if you want to be added to the distribution list. And lastly, before I turn it to Kieran, I'm just showing you the disclaimers. And with that, I'll turn it over to Kieran. Thank you.
Thanks, Mandy. Let me share my pack 1 second. There we go. Hopefully you can see that. So yeah, in the next section, I'm going to be talking through a couple of specific zero DT case studies, and also running a bit of a deconstruction on the multi-leg part of the zero DT market. And then we'll finish off with our top equity market hedges, looking forward from here. So for our first case study, we're looking at the busiest zero DT session on record. So the black line in the bottom left corner of this chart, of this slide, is showing you a moving average of zero DT traded notional. You can see the exponential growth that we've had over the last couple of years, with recent notional averaging around that kind of $650 to $700 billion a day level. But there's been 4 individual sessions over the last few months where activity has really been off the charts, and they're marked on as the black dots at the top of that chart. So back in July and August, you had 3 sessions where traded notional and zero DT hit around $830 billion. They were each around a particular market catalyst event. But then there was one session at the beginning of this month, on October 6th, when notional took another very big step higher. That was following a strong NFP print pre-open, but traded notional in just the same day expiry options was $965 billion. So almost $1 trillion transacting in a single session on that October 6th date. So there was any day where you might think that the positioning imbalances from 0DTE could have got more meaningful, then I think this would be it. And yet, if we net off the buyers and sellers through the session and calculate the same kind of accumulated dollar gamma number, which for October 6th was showing as the orange line in that top right chart overlaid against Mandy's box plots distribution, we find again a very high level of offsetting, meaning that the net dollar gamma imbalance didn't really deviate by more than $1 to $2 billion through the morning. So dollar gamma here basically being a measure of the delta rehedging expectations per 1% move. If you look at what the S&P did on this session, where you've got a spots history in the bottom right-hand chart, you can see that in the morning there was a large rally. It was about 2%. So scaling that by the gamma numbers, then delta rehedging flows shouldn't have exceeded more than $2 or $3 billion in total through that 2-hour window. And when you have the S&P futures trading roughly $140 billion, it probably isn't large enough to be driving any material market feedback from 0DTE. And if anything, if you look at the orange line top right, you can see that's positive, at least marginally, over the course of the day. So that's telling you that market makers were, if anything, net long gamma, meaning they'd have been buying on dips and selling on rallies, so creating more of a pinning effect, if anything. But it all adds to the case that buy and sell flow is very evenly balanced, as well as open and close flow, with people trading in and out of 0DT positions throughout the day, which all helps to limit the amount of net risk that accumulates during the session. So the October 6th example also had a pretty even balance between calls and puts trading within 0DTE, which you can see from the chart on the left here, showing the split of calls in green and puts in orange. We did see a small bias towards call options, which we do often see on days when the market's moving higher, so showing some people using 0DTEs to trade the upside, but it was still relatively split down the middle, I'd say. So it's definitely not the case that on a large rally, everyone starts trading only 0DT calls. There's a small kind of put call beta to the market direction, but again, it's pretty balanced on October 6th and also over time. So the chart on the right is then showing you a long run history of the put call balance for 0DTE. Most of the time there's actually a small skew towards put options, but much smaller versus the skew that we see in longer maturity S&P options flow, where you tend to see puts trading in roughly double the notional versus call options. And we've marked that split on for longer maturity S&P in the gray line on the right-hand chart there. You can also split 0DT flow relatively down the middle between single leg flow and multi-leg volume. So trades that form part of a larger structure are generally labeled as multi-leg on the ticket, meaning that we can allocate volume into each bucket. And yeah, again, we tend to see a fairly even mix between single leg flow, shown here in darker blue, and multi-leg flow, shown here in lighter blue, both on the October 6th session on the left and throughout the last year or so on the right. So if you go through and group all of the multi-leg tickets that printed simultaneously together, then you can analyze the shape of the kind of composite 0DT structures. And we find that the large majority of the multi-leg trades are call spreads, put spreads, or combinations of the two. So iron condors or iron flies, where you're trading a call spread and a put spread together. Here, shown in blue, makes up almost 90% of all multi-leg activity, which in turn is about half of the overall 0DT market. And the recent white paper from Mandy's team has shown that the large majority of these spreads are initiated on the sell side. So people selling spreads is a more defensive way to try and extract carry from the 0DT market. They're most active shortly after the open, but are typically then unwinding these positions later on, so generally not holding them through to the 4 p.m. expiry. And if we look at the gap between the strikes of these spreads, more than half of the flow within 0DT spread activity is structured with the strikes either 5 points wide or 10 points wide, as we can see from the bars on the left-hand side here. so the tightest possible strike differentials, you've then got about 3/4 of the flow trading with 20-point wide strikes or less. So these are predominantly structures where the maximum intrinsic value is less than 50 basis points of the underlying equity notional. So while the impact of this flow on the kind of headline gross traded notional numbers is large, given that it involves two legs and is often traded in and out during the session, the actual associated risk from the spread activity is fairly small. The spread flow is also quite tightly, on the next slide then, we're looking at the degree of gamma offsetting that we get when your strikes are so tight to each other. So here we're taking a specific 10-point wide 0DT put spread that was traded in large notional on October 12th. At the beginning of the session, the gamma profiles from two legs, shown in red and green in the top left-hand chart, almost mirrored each other. So that means that the net dollar gamma, shown in blue, didn't get to more than 10% or so of the equity notional per 1% move in either direction. The chart top right is then showing the dollar gamma for the same spread as of 3:30 p.m., so going into expiry. And you can see gamma levels starting to spike higher around the strike concentration, which we also see in Mandy's overall distribution, shown again at the bottom of this slide here, with the numbers widening out slightly into the close. But in aggregate, they're still not getting to really significant levels, I don't think. The spread flow is also quite tightly concentrated around the spot level, meaning that you don't need to see a particularly large move in either direction to break through the accumulated 0DT positioning earlier in the day. So these bars are showing you the distribution of call spread and put spread strikes relative to the prevailing spot level when they were printed, and we see very little trading more than 2 or 3% out of the money, meaning that it would only take really a medium-sized market move in either direction to end up the other side of that positioning, meaning that for the spreads, there's limited net gamma impact in a large move. It's really just a transfer of intrinsic with no real residual Greeks after the move. So these options that are 2-3% out of the money are still quite teeny from a delta perspective, and the overall premium in options with just a few hours remaining through to expiry is in percentage terms very small, even for the near to the money options really. On average, the net premium for these spreads tends to be around 6 basis points of the underlying equity notional. But that leads me on to an important point about the vast gap that we see between traded notional in 0DTE and traded premium and kind of real life market risk, particularly within spread activity when the headline notionals, you're adding up both legs and then potentially doubling again on the unwind. So to emphasize that point with a particular case study, there was a systematic put spread selling strategy that we observed trading through the first half of this year. So these spreads were always traded 20 points wide. It was always in the same number of contracts and they were always rolled consecutively. The maturity varied slightly, but it was always less than a week through to expiry, and roughly 1/3 of the transactions hit this 0DT same day expiry tape. But over the roughly 60 consecutive trades that we saw through H1, the strategy took in roughly $30 million in premium in total. And it seems like the net P&L that they managed to retain there was around $12 million. But over the course of these 60 trades and factoring in the rolling as well, they still managed to notch up more than $500 billion of total gross notional traded. So the contrast of seeing those numbers is hard to show in chart form. If you put it on a bar chart, as we have done on the right-hand side here, then the premium and the P&L numbers are almost invisible relative to the total notional. But to frame that another way, if the notional bar is scaled to be the height of the Eiffel Tower, then the premium bar is the diameter of a nickel, and the P&L is a small blueberry, as we've shown in the bottom right-hand side there. So that's not really to imply anything negative about this particular strategy. In fact, if you look at the chart on the left, the P&L stream from selling these put spreads was actually pretty consistent. with the losses they made in the March sell-off quickly recouped. But it helps to show this vast gap between headline traded notional in the spread flow and the real life risk. And it also helps to show the extent to which zero DTE impacts can be overstated by just looking at these headline gross notional numbers that tend to get the most attention, at least for the multi-leg component. So the single leg activity, the underlying notional is more relevant, and it makes up about half of the total volume that we see trading in zero DTE. Average single leg traded premium is around 10 basis points. So you've got $1 million of premium controlling roughly $1 billion of underlying notional. And so the potential gamma impacts can be more significant. But as Mandy's work has shown, the very balanced offsets between buyers and sellers has so far meant that the secondary market impacts has been very limited. And as long as the market structure remains as it is, then we don't expect to see market distortions coming from zero DTE. If, however, we were to start to see single leg flow becoming a bit more one-sided, with large buyers leaving market makers net shorts in more meaningful size, then that could change. You're more likely to see these dynamics playing out in the afternoon, as we've seen from the gamma amplifying slightly. But yeah, so far zero DTE flow has been very, very balanced, and so impacts have been limited. So I think I've got a couple of minutes left to run through some of our most preferred hedge structures through the months ahead. We're starting off with a vanilla hedge profile on the S&P. So the cost of buying outright options has risen recently as implied vols have moved higher, which you can see from the top left-hand chart. We're not yet back to the high vol levels that we saw last year, but still up a fair amount from the low-cost premiums that we saw through this summer. But one funded hedge structure that we like at the moment is selling a tightly struck call spread to fund a wide put spread. You can see the profile bottom left. So here, looking through to the year-end expiry, selling a 150-point wide call spread to fund a 400-point wide put spread, which was last week pricing close to flat. That gives you downside coverage basically back down towards last year's lows, which you can see marked on as the purple lines as your put strikes in that bottom right-hand chart, with much more limited losses to the upside, shown as the green lines there. So just in case we were to see the market squeezing higher once again, perhaps driven by a fresh round of AI excitement, this is a way to keep your potential losses in the event of a rally more limited. You can see from the mark-to-market chart, bottom left, that blue line, that the overall profile looks a lot like an in-the-money put spread. So it's selling skew and leaning into the recent re-steepening that we've seen in short-dated S&P skew, which is the purple line top right. Another hedge structure that we think can still make sense once implied vol has moved higher is a put option with a knockout feature that cancels the trade if realized volatility exceeds a given threshold over the life of the trade. So the discount from that knockout feature gets larger when vol is higher and the implied probability of a knockout increases. But if you think that any further market weakness from here is likely to be relatively orderly, then being able to halve the premium for a 3-month 95% put on the S&P by introducing a knockout feature that triggers if realized vol exceeds 30 can make sense, we think. The chart on the left puts that 30 vol knockout threshold in context, showing that it's only been the most extreme periods of the last 20-25 years when 3-month realized vol has gotten that high. And if you look at realized vol since the S&P market recently peaked in July, it's been just 12 over a period where the index has dropped 7 or 8%. So you're really playing for a continuation of this recent trend of the market going lower, but doing it in a relatively low vol manner. One other alternative hedge profile that we've seen a lot of interest in recently is within the hybrid space. So this is a structure that pays out 100% if in June next year, the S&P is trading more than 5% below its current level, and the US 10-year swap rate is below 4%, which is a bit less than 50 basis points below where the forward rates are pricing at the moment. So you pay 10% to put that on, meaning that you've got 10 times potential convexity if equities and rates fall together. And that's exactly the view from UBS research at the moment, where with their base case expecting a US hard landing to drive a reversal in rates and to take equities down together. And then finally, just to go full circle, we've then got a hedge on the VIX. So as Mandy said at the beginning, VIX calls have been very active this year, which you can see in the top left chart. And a lot of that activity has been in VIX call spreads. So with vol and vol of vol now slightly off its lows, these call spreads are a bit more expensive than they have been recently. We tend to look for roughly $1 premium entry level for a 2-month 20 to 30 strike call spread, so targeting 10 to 1 convexity once again. The VIX has spent more than 10% of the last couple of years above 30 and was above 20 for most of last year. So it feels like good value around that type of premium. You can see from the bottom left chart, that purple line is showing that we were around that $1 entry level recently. It's now more like 130, 140. If we were to get back down to around $1, then we think this is definitely a attractive kind of convex equity hedge to keep an eye on. But our team puts out a cross-asset volatility pack each Tuesday morning containing ideas along these lines each week. So if you'd like to be added to that, then please reach out. But that's the end of my section. I think turn over to the operator and we can open it up to Q&A.
Hi, just as a reminder, to ask a question, please select the raise hand feature, which can be found at the bottom of the Zoom interface. When prompted to unmute, please unmute and ask your question. If you've dialed in, please select star 9 to raise your hand and star 6 to unmute. First question is from Ratnakar Kota.
Hi, good morning. On your second case study, where you talk about selling put spreads on SPX, I believe you said, is it $30 wide put spreads or $40 wide? I forgot. But how far away is that from the current price? I understand the strike difference, the deltas, but like how far away are those generally traded in that case study from the current price?
Sure thing. So in this particular case study, this particular investor was moving the strikes around a bit depending on where the premiums were. They were always 20 points wide. They were initially ranging from kind of, I'd say around 2% out of the money on average. But that previous chart that I showed with the distribution of the strikes shows that the large majority of the spread strike flow is concentrated around that kind of 1% out of the money to 2% out of the money region. That second case study is relatively small versus the total notional that we see going through every day. But the strike concentration for this spread flow tends to be pretty consistent across the board. And yeah, it's 1 or 2% out of the money on average, I'd say.
Thank you.
No other questions.
Operator, do we have any other questions?
Don't have any questions at the moment.
I have 2 questions that were sent to me in advance from clients. One of them, Mandy, it seems to be geared for you. What is the breakdown between retail versus institutional trading in 0DTE? And then this question was maybe more geared to Kieran. Is 0DTE just an S&P phenomenon, or does it exist in other markets?
Yeah, sure. I can take the retail versus institutional breakdown. So a couple things. So, the net market maker gamma hedging flow that we showed, that's not an estimate, right? We see for every transaction, whether it's customer, net market maker. So those are not estimates. When we talk about retail versus institutional breakdown, those are our estimates because it's hard to see who the end customer is. We know, for example, like 90% of the flow in 0DTE come from retail brokerage firms. However, a lot of retail brokerage firms also service institutional clients as well. So it's hard to kind of break down exactly, but we can try, and we have tried. We look at not just the size of the order, but frequency of trading, the type of strategies that they run to really kind of get approximation of whether it's true point and click retail versus more systematic high frequency institutional flow. And our estimate is around about 30 to 40% of the flow in 0-day options is truly retail, how we think about retail. And the rest in the balance is more institutional type of flow, whether that's hedge fund or whether that's, RIAs or, other types of institutional like investors. And then in terms of other zero DTE, I mean, we have zero DTE on, at this point, mostly index and ETF. So, you have it on SPY, you have it on Qs, you have it on the E-minis, but not on single stocks yet.
Yeah, I actually have some numbers to add to that. In terms of the other underlyings, it's predominantly on the main SPX Cboe line. You've also got zero DTs on the SPYs, which is about a quarter of the size. Also on the options on futures, which is even smaller than that, and also NASDAQ and the Qs as well. But again, you're talking about 15% of the type of notional that goes through in the SPX. That's still the large majority of where we see the zero DT action.
Great. Operator, any other questions from the audience?
No other questions from the audience.
Excellent. Thank you, everyone, for joining our call today. We will be having a replay for anyone who wasn't able to join or joined a little bit late. We will send that out by tomorrow. But thank you very much, Mandy and Kieran, for presenting. We really enjoyed your insights. Have a great day.